Getting your trading week started from New York City for our audience worldwide. Good morning, good morning. Your equity market advancing 1/3%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, The Open with Jonathan Ferro.
From New York, we begin with the big issue, President Biden's next move.
The infrastructure bill, we still need to understand entirely what's in it.
Agree on what Build Back Better is and get it passed.
But certainly a prudent use of money to invest in infrastructure makes sense.
We're going to see some stimulus, and it's going to be spread out over years. It's going to be nothing compared to what we've seen the last 24 months.
The medium-term impact of Build Back Better on inflation is negligible.
We still don't know who's going to be the chair of the Fed.
It'll be quite interesting to see who President Biden actually nominates.
I don't think that the shift away from Powell to perhaps Brainerd is going to make that much of a difference.
I think it really matters. If you're now blaming everything on Powell, it allows the Democrats in Brainerd to start saying, we have to get this under control.
Whoever comes in is going to have to tighten rates.
Joining us now is BlackRock's Tony DeSpirito, FlowBank's Esty, Dwek, and Larry Adam of Raymond James. I want to begin with you, Esty, and get your thoughts on this Chairman Powell, Governor Brainerd face-off, if we can call it that. Who is to be the next chairman of the Federal Reserve and how consequential it might be? Esty, is this of consequence to you?
I think in the short term, it does have an impact on markets. I do think markets would be happier to have the continuity with Powell. And it does feel like Powell would have more flexibility in how he approaches the growth concerns over next year. And if we do see this slowdown back towards trend, and of course, the big inflation question, ultimately, it won't make that big of a difference over the next 6 to 12 months. I don't think, but in the short term, the more continuity, the better, and maybe more confidence that Powell can let things run hot a little bit or not, unlike possibly Brainerd, who'd want to maybe put her mark on the Fed and might have to react differently.
Larry Adam, there's a range of views on this. What's yours?
No, I still think that Powell is the heads on to get it. I think, as was said, continuity is very important. I think he's done a great job. And in my opinion, I think he's earned the right, given how he's been able to navigate through this pandemic. So I still think that he will get it, and it'll reduce some of the uncertainty. And if Brainerd gets the vice chair job, I think that's a win-win.
Tony DeSpirito, a win-win for you?
I do think that would be a win-win. I do think the market would like the continuity of Powell being reappointed. But I think whoever's in the spot has a hard job ahead of them, right? Inflation is definitely running hot. The Fed monetary policy is still extremely loose, as Powell has pointed out. Tapering is not tightening. And so I think there's a lot of work to be done at the Fed over the coming months.
Well, let's talk about whether this Federal Reserve is going to change their mind anytime soon. The incoming data is telling a story that is incompatible with the story they told at the start of the year. Inflation is higher, it's broader, it's stickier. Will they change their mind? We heard from Neil Kashkari, the Minneapolis Fed president, over the weekend with CBS. Take a listen as to whether he's changed his.
The challenge is these high prices that families are paying, those are real, and people are experiencing that pain right now. We need to pay very close attention to this. We need to take it very seriously. But my view is we also need to not overreact to some of these temporary factors, even though the pain is real.
Esty, this is the situation from my perspective, my standpoint. I see data that is incompatible with the messaging of the Federal Reserve this year. Yet I do not see a Federal Reserve, a Fed chair, Fed presidents who believe this was temporary, that have changed their mind. Do you believe they're inching towards that direction?
I really don't. Admittedly, inflation is higher than expected, and it's staying higher for longer than expected. And that is going to feed into 2022 because supply chain disruptions are ongoing. So for sure, this is longer and higher than the Fed anticipated. But at the moment, I'm not sure rate hikes would really make a big difference to the inflation question. I'm not sure this is the correct solution today. I don't think the Fed believes it is. They also realize that the unemployment question, especially for some parts of the labor market, are still not entirely resolved, that growth is going to be slowing in 2022, at least in the second half when there's possibility of rate hikes. We have midterms elections that they don't like to mess with, if I can use that term, hiking just before or around it, that becomes suddenly much more political. I just don't think they're going to be rushed into making a move. Larry
Adam, your take, please.
So I actually agree with Neil Kashkari. I think that they don't want to overreact this time around. When you look at what's happening, I think you really have to define that word transitory. Everybody throws around the word transitory, but they don't define it. We've been longstanding saying that transitory means that inflation would peak in the quarter we are in now, early next year, and then fade as we go into next year. And I still think that is the case. And if you think that you're going to get this hyperinflation, elevated inflation for a long period of time, I think you'd have to rewrite a lot of the textbooks, because I think a lot of the secular forces that have been driving inflation lower, like technology, like globalization, and like what we call the frugal consumer, those things would have to change. And I'll tell you, that frugal consumer is not changing. You're starting to see people balk at paying higher prices. And I don't think you really see this hyperinflation until you get that mentality where people start to panic and they have to buy.
Well, we don't see panic right now, but it's a fascinating moment. We see inflation at multi-decade highs and consumer sentiment at a decade low. Interesting for me to see the call from Morgan Stanley. They're looking for the first move in Q1 of 2023. They write inflation begins to moderate after February and the labour market nears maximum employment by year end. The Fed completes tapering mid-22, first lifts rates in the first quarter of 23. That's a constructive view on what the Fed might do. Maybe it's in line with where the Federal Reserve thinks it's going. What's interesting for me, Tony, and maybe you can comment on this, there's a disconnect at the moment between the people who believe inflation's going to be really hot and then their subsequent views on where they think the Fed is going. You'll hear things like a move in Q3 next year, another move in Q4, and another 50 basis points in 2023. That, for me, doesn't make sense. If you believe the Federal Reserve is behind the curve, surely they have to go quicker than that. Tony, wouldn't you agree?
Well, look, if you look at the components of inflation, some of it is definitely transitory. So I don't think these high levels will persist. I think the question is, to what level do we come down? And I think that is definitely higher than the levels that we saw pre-pandemic. Just look at some of the more sticky items like housing. We're starting to see those numbers creep up, for example. We're seeing wages creep up. So I think we are going to be at a higher level. I do think the Fed is behind. I mean, here we are in an economy where housing prices, for instance, are up 20% year over year, and yet the Fed is still in the market buying mortgage-backed securities every day. It just doesn't seem like that policy makes sense to me.
We heard from Brian Deese, the National Economic Council Director, as well over the weekend, speaking to CNN. Take a listen to what he had to say.
All of these things go right at lowering costs for American families, and this bill is fully paid for. It's not going to add to inflationary pressures, quite the opposite, because we're going to pay for everything in this bill by raising taxes on big companies, large corporations, and the highest income Americans.
Joining us now is Bloomberg's Anne-Marie Jourdain. Anne-Marie, the administration out in force over the weekend.
Yes, they certainly were, especially when it comes to the economy, Jonathan. We heard from Treasury Secretary Janet Yellen and Brian Deese on a number of networks. What he was talking about there, though, is the second part of the president's agenda, the Build Back Better agenda, nearly $2 trillion. And this week, the House is supposed to take that up. Remember, we're waiting from those Congressional Budget Office to score that bill for those moderates to want to tag on to that. And then I'll go to the Senate, where given the fact that inflation is such a concern right now, even in members of the president's own party, this week you had Chuck Schumer, the senator from New York, telling the administration to hit the SPR so you have a little bit of consumers having a bit of an ease at the gas pump. They are trying to say that that second bill will not impact inflation, especially not in the immediate term, and actually economists say longer term it'll ease those concerns. Today, Jonathan, though, the president's going to be signing the hard infrastructure agreement. And given where his polls numbers are, approval rating at a new low of 41%, the administration is really hoping that that hard infrastructure, shovels in the ground, can really help bring up his approval numbers.
Anne-Marie, just weigh in on the Fed chair race just briefly. I told you I'd ask you all week until we got a decision. What's the latest?
Well, potentially we'll get a decision as soon as this week, according to the Wall Street Journal. Their latest reporting this morning gave a little bit of, we get these news drops on what the discussions potentially look like for the Fed chair. And what they said was that Chair Powell and Governor Brainard went in with the president, met for around a similar time, but Brainard actually went over her allotted time. Not sure if we should read too much into that just yet. But another interesting tidbit, Brian Deese was the only advisor in that room with the president. So it does seem to be like he has a lot of influence in this decision.
Gary Cohn did as well back in the day too. Anne-Marie, thank you. Anne-Marie Hordern down in Washington, D.C. on the latest. A lot of outlooks starting to pour in right now, and I've picked up on Morgan Stanley's, who put out a lot of research over the weekend. Their view on inflation and on growth is fascinating. They see PCE coming down to 3%. They see GDP ending the year in and around 5%, yet they are not bullish on this equity market. The S&P 500 year-end next year, 4,400, overweight Europe, overweight Japan, underweight the United States. Esty, Dwek, what's your view on this particular story, this call? 4,400 year-end next year. I believe you push back.
Yes, I would push back. The reality is it's difficult to imagine the U.S. underperforming so much or having such negative growth when you still have higher growth than other regions and above trend growth. At the moment, fundamentals are strong. Margins are at all-time highs. Earnings were much stronger than expected, given the Delta variant and supply chain challenges in the third quarter. Of course, it's going to ease a little bit from a year-on-year perspective now that we're coming more into those reopening quarters, especially as we go into 2022. But I don't see any major obstacle today that suggests these fundamentals are going to disappear entirely. As I said, the Fed, I think, is going to stay on a relatively cautious path and not going to hike overly aggressively. We'll have some fiscal support, at least the hard infrastructure, if not much more, though that does take a little bit of time to move forward. But companies have proven they are able to adapt. They've been able to pass on some of the costs. This might not last as long, but they can squeeze margins a little bit. So difficult to be that negative on the U.S. equity market for next year.
Tony, just a final word on this, if you can. It's fascinating that when we have a conversation on inflation, we leave out the conversation on GDP. The forecast for next year, even with a 3 handle on inflation at some shops, at the same house, you'll see a GDP forecast, real GDP of 4 to 5%. Does that get it done? Does that keep you invested, Tony? Isn't that good for this equity market?
Oh, I'm very encouraged for the equity market. First of all, while we do have rising inflation, we have very negative real rates. And I think that's pushing investors even further into equities. So I think that creates a nice bid for equities. And then when I think about the U.S. versus Europe, I think people look at multiples and say, gee, the U.S. multiple is so much higher than the multiple in Europe. That's true, but what it misses is a look at fundamentals. And the quality of the companies in the U.S. is much superior, and is the long-term earnings growth. And so I look at it, and I'm still very favorable on U.S. equities.
It's the view on real yields that I think separates Morgan Stanley from a lot of other people right now. We can build on this through the hour. Esty, Dwek, Larry Adam, Tony DeSpirito. Coming up on the program, OPEC staying the course as President Biden faces mounting pressure to tap the SPR.
That decision has been taken before. The U.S. have been doing that for a very long time. And I think they'll continue doing that until 2025.
That conversation up next from New York. This is Bloomberg.
We need immediate relief at the gas pump, and the place to look is the Strategic Petroleum Reserve. So that's why I'm urging the administration to tap that reserve, get the prices down.
Senate Majority Leader Chuck Schumer there urging the president to release oil from the country's emergency reserves. The National Economic Council Director Brian Deese saying that the administration is not ruling anything out.
The president has made clear that all options are on the table. We're monitoring the situation very carefully.
Joining us now is Bloomberg's Julian Lee. Julian, always great to catch up with you, sir. It's the what next in Washington on this front.
Yeah, I mean, I think to some extent the expectation of an SPR release was created before the OPEC meeting earlier this month. It was sort of said that if OPEC didn't come forth and produce more oil, then the administration would have to do something. And I think having said that, they probably do need now to follow through with it. Is that going to suddenly put more gasoline on forecourts? No, it's not. The SPR holds crude oil. The sale process itself will take time. But what it will do is send a signal that the administration is putting more oil onto the market. I mean, a 20 million barrel SPR release, which is what some people have suggested could be done very quickly by bringing sales that are already scheduled for next year forwards into this year, that over the period of a month is equivalent to a 670,000 barrel a day production increase by OPEC Plus or whoever. That's more than the administration was asking them to do. So I think that does send a powerful message, even if it's only a one-off hit.
Julian, beyond where prices are right now, as you look through the curve, how much belief is there in this oil market that these conditions last? That this tightness in the oil market keeps delivering prices this high?
I think it really depends who you talk to. I mean, one of the things that the OPEC Plus producers have been saying fairly consistently is the market may be a little bit tight now, but it's not really that tight, and inventories are going to start growing next month, and next year we're looking at a massive surplus, and this is why we need to be very cautious about putting more oil more quickly onto the market. But if you actually dig into OPEC's forecasts, as I did in my column that was published on Sunday, you see that this whole surplus is built on an assumption that the producer group pumps at its target level, adding 400,000 barrels a day every month. Now, we know they're not doing that. They are already somewhere between 600,000 and 700,000 barrels a day below their target. They're not adding the full 400,000 barrels a day each month because some members can't. And so this forecast of a huge surplus is simply built on erroneous production data from the group's own members. People are starting to talk about demand. That's the other side of the balance, and that may soften a bit from what people are forecasting. But these production numbers that OPEC is using to justify keeping a rein on things are completely fanciful.
Julian, great to catch up. Let's stay close through the week because this story is just getting going. Julian Lee there of Bloomberg, back with us. Tony DeSpirito, Esty Dwek, Larry Adam. Esty, your words, growth won't be derailed, fundamentals are strong, stay invested, inflation is still transitory, the Fed won't change path. Where does energy fit in to that story?
It's definitely a question, but the reality is the Fed is going to look through the energy prices. And as we move forward in the coming months and we look to 2022, we would need something like a $40 increase in oil for the inflation rate to stay as high as it was in the last couple of months. And I don't think that's going to happen. We have found something of a stabilization here. So it's clearly something that Americans in particular react to, as they were saying, at the pump. But it can impact inflation. Central banks are going to look through the energy, and there is a view that we probably get something of a stabilization across this price throughout 2022.
Tony, within this space, in mining, in energy, we've seen the mistakes made in previous cycles. Prices up, they come in, they dig a hole, they pump more oil. Take your pick, they spend more money. This time around, I see discipline. I've seen it from the miners since things blew up at the turn of the last decade. We're seeing it from the energy players now as well. Tony, does that give you some confidence to stay invested in this sector?
Yeah, I think for the medium term, oil prices are going to stay high, and here's why. First of all, oil prices have been depressed since 2014. So the oil patch has been in a recession for 5-6 years now. And what that tells me is that at the beginning of any recovery cycle, companies are always very hesitant to spend. It's just natural. Two, there's increasing shareholder pressure that shareholders want oil companies to return capital to shareholder rather than putting it into the ground. And then finally, there's ESG. All the major energy companies are looking at oil and they're saying, okay, eventually demand is going to peak. It's not anytime soon because we aren't selling enough electric vehicles. Never mind getting electrical vehicles into the fleet for that to have a major impact. But they're looking at it and saying, okay, there is a point in time in which oil demand peaks, so I need to be really conservative. And so you're seeing that. Just look at the rig count. The rig count is hardly moving despite oil prices being at $80. I think that means oil prices will stay strong for longer.
Brent right now 81.17, WTI 79.75. Just want to give you the final word on this, please, Larry. The final word.
So when it comes to oil, I still think that that's probably the biggest risk scenario. If you continue to see oil prices surge, it could obviously negatively impact consumer discretionary spending and negative sentiment. So that is the biggest risk. I don't think it's going to go there. I actually think that there is incentive now for oil producers to start to produce more. If you look at some of the earnings that have been coming out, they're actually putting money now towards investment as we go into next year. And I get that at the beginning of this year, when oil was closer to 50, the incentive wasn't there. But now when you got $30 above break evens, I think the incentive is there. And I think you're going to see that response come with more supply coming to the market here in the U.S.
We will see. Larry Adam, Tony DeSpirito, Esty Dwek sticking with us through the opening bow. Coming up, your morning calls, and later, it's a busy week of earnings with some of the world's largest retailers still in the spotlight. That conversation just around the corner as we count you down to the opening bow and kick off a brand new trading week. 8 minutes away with equity futures up 15. We advance 1/3% from New York City this morning. Good morning. This is Bloomberg. 5 or 6 minutes away from the opening bell in New York City this morning. Good morning to you all. Your equity market up 1/3%. Marginal, small, mild move lower last week on the week, down by 1/3% or so after we finished the week pretty strong on Friday. We're up across the board here on the Russell up 0.5%, on the Nasdaq 100 up 0.4%. As we look out to 2022, the range of outcomes incredibly wide, and the views on Wall Street too. 50-50 was the view from RBC's Lori Calvasina earlier this morning. We'll touch on that a little bit later. Morgan Stanley looking for 4,400 year-end next year. They look for plenty more downside. The call from Morgan Stanley, patience for the Federal Reserve. Switch on the board and get to the bond market. 2s, 10s and 30s. Yields unchanged on the session on 2s. We're up to about 51 basis points on 2s. Morgan Stanley don't think the Fed makes a move until Q1 2023. Even with PCE with a 3 handle, even with GDP close to 5, they think this Federal Reserve can remain patient as inflation fades and employment starts to improve. Employment growth is what we all want to see, and that participation rate start to inflect higher too. Your yields are up 2 basis points on 10s to about 157.68. That's the price action here in the morning calls. We begin first up with UBS, upgrading Chevron to a buy, a 125 price target. The analyst anticipating higher oil prices and strengthening demand. That stock is up 0.5% at 114.80. Your second call from Morgan Stanley initiating coverage on CrowdStrike with an underweight rating. The analyst expecting growth to start stalling and increasing competition. We're down there by almost 3.9% at 273.34. And your third and final call from KeyBank, raising its Netflix price target up to $7.25, growing more confident about the company's ability to increase net subscribers. That stock just inching higher by 0.25% to 684.26. Coming up, a big week for retail earnings, offering new details about the supply chain and the health of the US consumer. That's all just around the corner from New York City. Your opening bell is next. This is Bloomberg. 25 seconds away from the opening bell in New York City this morning. Good morning to you all. Your equity picture looks like this. Up 13 on the S&P, advancing about 1/3%. On the Nasdaq, up about 1/3. On the Russell, the small caps looking good, up 0.5%. The outlook for next year, a key conversation on this program this morning. That's the opening bell. Switch on the board and get to the bond market. Yields look like this on 10s. They come up 2 basis points to 158.19. In the FX market, euro-dollar unchanged at 114.40. And I've said it all morning, look out below on crude. We're down by 1.5%, 79.57. Call it 79.60 now on WTI. As this conversation starts to build about what the US and this administration could do to help bring prices down at the pump. Your equity market there, up about 0.1%, 20 seconds in. We advance utilities top of the pile at 0.4%. Bottom of the pile so far, real estate down by 0.05%. Just short of 4,700 on the S&P 500 right now. I caught up with Lori Calvasina of RBC a little bit earlier this morning on the path to her call, the path to 50-50 year-end next year.
Even though economic growth is expected to cool off next year, and we do have some hurdles to get through, frankly, on supply chains and inflation, if we're right about where the economy is going to end up next year, if it's about a 4% type number, which is what the economics community is anticipating right now, we should be getting to somewhere around 5,100 on the S&P.
Something around 5,100 on the S&P. That's the upside from Lori Calvasina of RBC. Joining us now, Tony DeSpirito, Esty Dwek, Larry Adam. Tony, you've talked about the composition of the earnings story, the resilience of corporate America. Can you build on that for us?
Sure. I think what you're seeing is earnings that have been extremely strong. You see it in the quarterly earnings, right? Revenue growth up 17.5%, EPS growth up almost 40%. Now, That's going to moderate for sure because that's normal and that's natural. And I call it a normalization process. And we'll also see the size of the beats, both in terms of revenue and EPS. I would expect that to start to normalize as well. And you could even say we saw some of that this quarter in that both the revenue and earnings beats were above the 5-year historical average, but below the more recent average of the last 4 quarters. And so I would expect to see continued normalization, but that means still very good growth and I think very good things for stock markets.
Tony, you've had some very good performance. I'm looking at the portfolios that you help manage, help oversee. More than 20% returns across the board year to date against the S&P, which is something in and around that. It's been a fantastic year and you've done more than keep up on some cases. Tony, I just wonder how your thinking, your investments have evolved through the year. Have you stuck to the same game plan through the last 12 months? Has it changed? And does the game plan change going into next year?
So over the last 12 months, we've had a game plan that's basically about balancing your portfolio, investing in some of the most deeply depressed cyclical sectors. We have overweights in energy and in financials, most notably. Those are the stocks that got hurt most by the COVID pandemic and have the most to recover. I still think those will be incredibly strong next year. We've talked about energy, and I think rates are very good for banks. In fact, banks are one of the few sectors that would benefit from rising rates. So that's one side of the barbell. The other side of the barbell are what I would call high-quality, stable compounders, notably tech and healthcare. Tech has done quite well this year. That sector has a lot of innovation, a lot of growth, and what's interesting is it's proven to be equally as stable to consumer staples. So you get better growth and same stability. And then healthcare has lagged this year, but I think that's still a very interesting sector going into next year. Again, it's an area where there's lots of innovation. That's good for growth. Demographics is very strong and good for growth. We're aging. When you age as a society, you need more healthcare. And yet we see very reasonable valuations there. And so that's another sector we like. And so that's really the play that we've had. And I think that play endures for next year.
Larry, does that balance make sense to you, sir?
It does. I think the equity markets are going to go higher as well, mainly on the back of stronger earnings. And right now we have a target for the S&P 500 of next year of 49.50. That's based on earnings of $225 for the S&P 500, but that was baked in using a corporate tax rate of 25. So assuming that is off the table, there's an upside risk to our earnings and obviously upside risk to that target by the end of next year. Similar to what Tony said, though, I would focus on those sectors that have the best earnings growth. That's going to be in your cyclicals, so it's going to be in a lot of the sectors that he mentioned: financials, consumer discretionary, communication services, and energy. So I do like those sectors as well.
Larry, I've talked a lot about Morgan Stanley and their call for this equity market. 4,400, it's downside from here, from then. What separates them and others is this call on the real yield starting to push higher. Some people think it will remain depressed. Other people think we can make this gradual move back towards zero. Is that a factor in your thinking at all, Larry?
It is. So there's a couple of things. First of all, I think that you have to look at the tenure of this bull market, right? And we are very early in this bull market. It's only 1.5 years. Historically, they last 6 years. If you look, a lot of people are always looking for the market to be negative because we've had 2 positive years. But let's keep in mind that if you go back over the last 3 bull markets, you had 9, 5, and then 9 straight years of positive performance. When I look at where the equity market is now from a PE perspective, you could say that it's elevated, but when you compare it to where yields are, I still think that this market is still very attractive, and that's why we continue to think it goes upwards from here.
Esty, can you share your views on that as well? Your view on equities in response, in relation to what's happening in this bond market?
I tend to agree. I mean, I think we look at valuations from a historical perspective that were calculated when PEs were much higher, and when rates were much higher. And that means that, yes, your valuations do look a bit high, but there's still plenty of potential. And as long as the earnings continue, and even if real yields move up a little bit, they're still very far in negative territory. Even if they come closer to zero, I don't think that changes the balance so much. So again, it's back to those fundamentals, it's back to having maybe not as many tailwinds, but certainly not the biggest headwinds yet. And this earnings growth with GDP growth both going to continue, and consumers doing what they've been doing.
Tony, I've heard you made this call so many times. You've come on this program and talked about it. Don't look at equity valuations in isolation. Look at them relative to what's happening elsewhere. Is that a key factor in next year?
Yes, absolutely. I think you have to look at what I'd call the equity risk premium, kind of the gap in between rates and earnings yields. And the equity risk premium is still quite high given the 10-year Treasury at just over 1.5%. And so I think that is very supportive to stock prices. The other thing I'd say is you have to look within the market, and this is where it comes down to stock picking. Not all stocks have high multiples. In fact, we've done some work looking at the lowest quintile of valuation, so cheap stocks in general. Over the last 25 years, those cheap stocks have traded a multiple of 12.4 times. Today, the multiple on cheap stocks is actually lower. It's 11.4 times next 12 months earnings. I think that really creates opportunity for stock picking.
The equity market right now up 0.25% on the S&P, about 7 minutes in. We'll talk about some single names now. The retailers in focus over the next week. Taking a look is Bloomberg's Katie Greifeld. Hey, Katie.
Hey, John. Well, earnings season isn't over yet. Like you said, some of the biggest retailers take the stage this week. Walmart and Home Depot kick us off tomorrow, followed by Lowe's and Target, and finally Kohl's on Wednesday. And John, this is the sector to watch. Obviously, these retailers at the epicenter of rising costs on everything from materials to labor as those supply chain issues persist into year end. And we know that companies have managed to pass on those higher costs. Margins are strong, but inflation is really starting to weigh on consumers. Friday data showed that the University of Michigan's sentiment index dropped to a 10-year low in October, climbing costs for food, gas, housing, all taking a combined hit on pocketbooks. That is the backdrop that these retailers are reporting into. And as we head into these earnings, let's take a look at some of this year's retail winners. Of course, you have meme stock GameStop way out in front with a nearly 1,000% gain. Beyond that, though, it's the specialty retailers that are leading the charge. In fact, only Macy's and Dick's Sporting Goods are the mall anchors on this leaderboard, John.
Katie, thank you. Let's talk about the retailers. Inflation is at a multi-decade high in America. Consumer sentiment, it is a decade low in America right now. Yet UBS's Terry Jacobson still betting on the U.S. consumer.
The consumer still is in relatively good shape. And I think that those confidence numbers could resume once the supply chain issues are resolved. Companies that have pricing power will do very well, and companies that will struggle will probably the consumer staple area. The story is strong corporate earnings, a very accommodative Fed, and a consumer that's in very good shape.
Esty, this is a tough one to read right now because we know a lot of people are in pain. Consumers suffering with higher prices. We know that. In the data, we can see it. Sentiment at a decade low. We can see inflation at multi-decade highs. At the same time, output numbers are good. Margins are still wide. Profitability is pretty decent. Can you still bet on the U.S. consumer in this market, in the equity market?
Absolutely. I think, one of the first rules has to be do not underestimate the U.S. consumer. And as my colleague from UBS was saying, they're still in relatively good shape. They have a good balance sheet. They're sitting on trillions of excess savings. Yes, at some point it's going to decelerate a little bit because the price is going to become too high, and that is going to help with this transitory storyline for the inflation picture. But for now, I think this is still going to continue. And even if it slows a little bit, even if prices become a little too high in 2022, I don't think we're going to see a sharp collapse in demand or in spending, and therefore not in earnings either.
Larry Adam, your thoughts?
This is definitely a consumer-led economy. All of our spending combined represents now 71% of this economy. And I think it's going to continue to see a lot of money accrue to the consumer, whether it's through job growth, whether it's through wages increasing, whether it's the adjustments that we're going to see for retirees because of the largest COLA adjustment that we've seen. And then keep in mind that consumers still have a significant amount in savings. We factor in that they'll probably spend at least 20% of that this year. So you're talking about a lot of money that consumers are going to have to spend over the next 12 months, and that will continue to power this economy.
Tony, final word, sir.
So it's pretty clear consumers don't like rising prices, and I think you see that in the survey data. But on the other hand, and I think this is more important, the consumer's in great shape from both an income point of view and a balance sheet point of view, right? We see improving jobs growth, we see lots of job openings, that's good things and we see higher wages, that's good things for income. And then on the balance sheet side, balance sheets improved across the spectrum for consumers during the pandemic. So I think consumer spending continues to be strong despite the weak survey data.
Tony, thank you. Really thoughtful stuff, as always, from Tony DeSpirito, Larry Adam and Esty Dwek. Some headlines coming out of the UK I want to bring to you very quickly. Governor Bailey talking again. I'm sure Guy Johnson's going to pick up on this a little bit later, so I'll just bring you the headlines and Guy can bring you some of the commentary a little bit later on this morning, in the next hour maybe. Governor Bailey saying, I'm very uneasy about the inflation situation. The labour market is the crucial part of the rates call. The UK labour market looks tight. The risks to the UK economy are two-sided. For those of you that got whipsawed by the last Bank of England rate decision, just having a quick look on the Bloomberg right now, when the next Bank of England decision takes place, it's the middle of December, December 16th, the day after the Federal Reserve, the same day, I believe, as the ECB. One for you to talk about through the day over in the UK. Coming up here stateside, worldwide, it's high stakes, a high-stakes virtual summit, gearing up for President Biden's big meeting with the Chinese President Xi Jinping.
We hope the tensions don't continue to rise because, as we know, they're high enough already. There's many issues on which the U.S. and China both need to cooperate but have different views about. We certainly believe that there is some deals to be struck.
That's next. This is Bloomberg.
About setting the terms, in our view, of an effective competition, and also discuss areas where we can work together, which certainly will be part of the president's conversation.
White House Press Secretary Jen Psaki setting expectations for the US-China virtual summit. David Dollar of the Brookings Institute seeing plenty on the agenda, but expecting little breakthrough.
There hasn't been that much advanced preparation, so it'd be very surprising if there were much concrete that came out of this. But on the other hand, it's really good the two presidents are talking. On both sides, there's been a lot of loose talk about Taiwan in particular.
Bloomberg's Anne-Marie Jourdain joins us now. Anne-Marie, on this specifically, what are you looking for?
Well, John, there's really going to be no deliverable. So what we do want to hear, though, in terms of a readout is, where did they exactly discuss, given there is a litany of issues? What was really top of the agenda? For China, it's likely going to be tariffs and Taiwan. For the United States, we do know for them, it's about making sure they press Xi Jinping, who's really coming into this meeting with a strong hand, given what happened last week with a key Communist Party basically saying that he could potentially rule for life. He has really centralized power. They're going to make sure they push him to abide by the international rules-based order. What the White House is saying is that this is a virtual meeting. It was billed as originally a summit. Now it seems like it's just a meeting. And Jonathan, they want to make sure that they set expectations and guardrails for engagement with China to make sure that lines of communication are open so that when they are competing, they are not going into issues of misunderstanding. And potentially, we were seeing that with Taiwan, given what the president recently said at that CNN town hall. When asked if the U.S. would come to the defense of Taiwan, he said, yes, Xi Jinping is going to be looking for an answer on the president if they're still going to abide by that strategic ambiguity when it comes to Taiwan.
Anne-Marie, from where you're standing, your perspective down in Washington, is this a conversation that leads a little bit more heavily in towards foreign policy as opposed to, say, the economics of the moment?
Well, the White House says the president is coming in with a strong hand, given the fact that hours before he sets foot into this meeting with Xi Jinping virtually, he would be signing that hard infrastructure. And they are billing that along with Build Back Better. Also, another bill, Jonathan, right now in Congress, specifically about fortifying U.S. domestic agendas so they can compete with China. But one more note on the foreign policy issue, Jonathan. We should also note this meeting is virtual because Xi Jinping has not left China since the start of the pandemic. It's about 21 months and counting. So they have to do this meeting virtually. So it's going to be interesting to see what can happen next. Potentially an in-person meeting could be set up following this. And there is a precedent about potentially meeting and then issues being resolved a few months later. When Xi Jinping and Trump met at the Argentina G20 in 2018, there was a 90-day tariff truce. So I'm going to be looking forward if there's anything in regards to trade, tariffs, Taiwan, when we hear this readout.
Anne-Marie, thank you. AMH down in D.C. on a virtual summit coming up a little bit later. For this market, about 20 minutes into the session, advancing 0.2%. Hasn't really been talked about much this morning, but the data out of China wasn't bad at all. In fact, it was okay. Some signs of stabilization. Nomura is saying the following. Overall, there is some improvement, especially in the mining and utility industries. Damien Sasser at Bloomberg joins us now for a little bit more. Damien, actually not bad over the weekend, this data.
Not terrible, Jonathan. Look, the industrial output data, that was really what you're referring to there. I mean, the fact that power shortages are sort of subsiding, the economy is beginning to stabilize on that front. But underlying that retail sales data, I mean, that is more inflation. I mean, that is basically price increases, which are driving the 4.9% headline figure. And so I wouldn't read too much into it. Really, for me, it's about the mortgage sector, right? And what we've seen is for the second month in a row, new home sales decline. Remember, we haven't seen that in 6 years, going back to the global financial crisis. And prior to that, you'd have to look back as far as 1995 to see new home sales actually declining in China. And so that's definitely got our focus amidst everything we're seeing here with CAISA, now going into grace period on 2 more of its bonds and the Evergrande payments, which were made last week.
Damien, work with me just for a moment, because we've talked about this calm in markets. I caught up with Bill Dudley, formerly of the New York Fed. Take a listen to what he had to say on how high rates could go at the Federal Reserve.
The market expects the peak in short-term interest rates for the federal funds rate to be around 1.75%. 1.75% peak in the federal funds rate in this business cycle will be the lowest peak ever.
Does that have a 3-handle, Bill, just to squeeze that question in? What kind of numbers are you thinking about, yeah?
Probably 3 to 4, yeah. That's what I would,
well,
obviously, the crystal ball is cloudy as you get further out.
There we go, Fed speak.
Damien Sasser, 3 to 4 on the Fed funds. What did you make of that call?
Well, Jonathan, our call for terminal Fed funds is 2%. If you ask Ira Jersey, my colleague, we could definitely see it go as high as 3%, although in this market, I don't think that's very likely. Again, I'm not the U.S. interest rate strategist for BI. You'd have to ask Ira that. But if that indeed happens, that is not good for inflation. I mean, that is not good for emerging markets, which is where I live and breathe, because that means there's going to be a lot more central bank rate hikes ahead. They're going to choke growth at the local level. Definitely not good for the real economy on the ground in many of the markets in which I cover.
That's precisely why I brought it up. Damien is going to catch up, sir. Damien Sasser of Bloomberg Intelligence. If you want to watch the full interview, do that. Get on Bloomberg.com on the Bloomberg terminal. That was a fascinating conversation with the former New York Fed president. Let's get you some sector price action this morning. We can do that with Kriti Gupta. Hey, Kriti.
Well, good morning, John. You see green on the screen right now. A lot of this has to do with a little bit of a defensive big tech in the green, as well as some of your defensive utilities, for example. To the bottom, you have materials and energy. They are lagging as you see commodities lower. In the middle of the pack, you see industrials, and that's really where a lot of your point contributors are today, thanks to news coming out of the Dubai Air Show. Airbus, for example, saying signs of recovery in aircraft demand are showing up, and you are seeing that show up in a lot of the aerospace and defense players in particular. Another big one, the heavy hitter in the Dow and the S&P 500, Boeing getting close to reinstating the 787 Dreamliner and renegotiating, certifying the 737 MAX with China, one of its major customers. John, let's see if that momentum sustains.
Kriti, thank you. Thank you very much. Kriti Gupta on this equity market and your sector breakdown. Coming up, your trading diary, looking ahead to the week ahead, featuring U.S. retail sales and a whole lot more from New York. This is Bloomberg. It's a slow start to the week so far. About 25 minutes into the session, equities up 0.2% on the S&P. The Russell advancing about 0.06% on the Nasdaq up a quarter. Big conversation about the Fed's next move. Are they uncomfortable with the incoming data? Bank of America suggests they might be. Switch up the board and get to the bond market. 2s, 10s and 30s. Your 2-year yield up a basis point to about 52, up 3 on 10s to 160. Let's call it 160 at 159.40. On 30s up 4 to about 197. So a little bit of a lift in the curve through the curve from 2s out to 30s. That's the price action. Let's get you the trading diary. We begin first up with President Biden signing his infrastructure bill into law later this afternoon, followed by the president's meeting, a virtual meeting, with the president of China, Xi Jinping, at 7:45. Then it's a ton of Fed speak on Tuesday with President Barkin, Bostic, George, and a whole lot more daily as well on the agenda. Plus, we'll get U.S. retail sales for the month of October tomorrow. Looking forward to that data point. Then a host of retailers reporting throughout the week, including results from Walmart and Target too. Finally, initial jobless claims coming out on Thursday morning. From New York City with your equity market slightly positive, thank you for choosing Bloomberg TV. Fascinating week ahead. Looking forward to covering it with you. This was the countdown to the open. This is Bloomberg.